Good afternoon, good evening, whatever time of the day it is that you're watching this latest edition of Down the Middle. We have Jim Chanos with us today. He's founder of Kynikos Associates, an investment firm and arguably the world's preeminent short seller. And that means, for anybody who's unfamiliar with the idea of short selling in general, that means you profit when prices decline. Jim, welcome.
Thanks for having me, Danielle.
Before we get into kind of what you do and what inspired you to do what you do, can we talk a little bit about art? Because I'm a big fan. I've got a cousin in New York who's got the largest private collection of drawings in the country. So I'm curious, what kind of art interests you such that the BBC did an entire documentary, The Banker's Guide to Art?
That was a long time ago. I've been a collector since pretty much the late 80s, early 90s. And I'm kind of on two ends of the spectrum, contemporary art on one end, which is what I think the BBC was interested in. And then some ancient pieces from the ancient world. I'm kind of literally on both ends of the spectrum. But I haven't been buying anything now for a number of years. The market, like a lot of asset markets, is just gotten kind of crazy.
I bet it has. Presumably, some of the ancient art has come from Greece?
Yeah. Well, of course, provenance is always an issue there, so you have to be very careful that you're legally acquiring anything. But yes, mostly Greek and Rome.
Interesting. So you are. I'm the product of Italian immigrants. You're the product of Greek immigrants. Your parents were first generation, I believe?
Well, my mother was Mary Catherine Sullivan, so she was quite Irish. But my father was first generation Greek American.
And I'm curious. So I'm almost more curious about your mom, but I'm going to ask about both. So Milwaukee, this is where you grew up.
It was.
And your mother was an office manager for a steel company, a steel mill.
Yeah.
What was it like growing up in the Rust Belt before it was rusty? And what was manufacturing in America when you grew up?
So I like to talk about sort of the tug of war, the pendulum between capital and labor. And the story I tell is that in the summers of 1978 and 79, I got a job working in steel mill in Milwaukee for Babcock and Wilcox, which was owned by Inland Steel at the time. My mother worked for Inland Steel. And I had to join the union. And I was a proud member of Boilermakers and Pipe Fitters Union until the early 90s. But I was making the equivalent of $14 an hour in 1979. And basically, for 2 months out of each year, I paid for my college education by working a union job in steel. But that was the peak, right? That was the peak in the American labor movement. We saw the election of Thatcher that year in the UK and Reagan in the US.
Sure.
And the pendulum, which had gone from post the Depression, increased Keynesian, increased statist, reliance on labor, began to move the other way toward a preference for capital. And my job in 1978-79 is the perfect sort of microcosm of that.
That's fascinating. I worked in a steel mill. I worked for a steel company in Caracas earlier on in my life, and it was interesting to watch China's increasing influence in that arena in Venezuela. This is prior to Chavez coming on, but manufacturing certainly has changed worldwide since 1978, 1979.
Sure has. Well, I worked on the mill I was at made tubular steel, and we had two basic end markets. We had the drilling business, which was going great guns in the late 70s, and we also made reinforced pipes for nuclear power plants. And I remember being at school in the spring during that period, it's 78 or 79, I guess it was 79, and the 3 Mile Island incident occurred, and Walter Cronkite very somberly said that, and the piping was made by Babcock and Wilcox. And I turned around to everybody in the TV room, in our college TV room, and said, "Hey, I worked on those pipes."
Oh gosh. Oh my gosh.
Yeah. So little interesting side note.
I will never I will always associate you now with 3 Mile Island. Don't take that the wrong way. I also want to talk about the idea of, and I'm jumping ahead here, but your father ran a chain of dry cleaners, and
it was a family business with his two brothers.
So, services in America, how inflation in services, during the coronavirus, I think it was 12 months between the time that I made one trip to the next to the dry cleaners. What are your views on how Americans back then consume services and how they consume them now? I know these are off-ball questions, but I'm just curious because of your background. You have to have some perspective on these things.
Well, yeah, I mean, obviously, the way services, some services are consumed and delivered has changed dramatically. I would bet that back then people actually came to the dry cleaners to drop off their clothes, right? And I think we had for a handful of years a premium delivery service that we charged that nobody basically used. And today I think that's completely different. Convenience matters. Services and goods are often just simply delivered to your door. And so obviously the whole idea of small businesses being able to make it when up against any sort of larger corporate entity that can do this. I'm not sure if Walmart's still doing pickup dry cleaning, but I bet they are. And so, that has changed the way we've looked at lots of small service businesses that probably flourished in the 60s and 70s that have seen probably a real slow decline in the last few decades.
And especially in the last 2 years,
of course.
Which is a shame. So I'm curious. So you're at the University of Wisconsin right now, and you teach students today about financial fraud. How does that carry over with a younger cohort of students who think that maybe markets only go up because they've been born into an era of endless Fed liquidity?
So first of all, I want to clarify for the viewers that it's a course on how to identify financial fraud using a historical narrative, not how to commit it. So we want to be pretty clear about that. The course at Wisconsin is the same course I teach at Yale, and it's become a pretty popular course. But it's for MBA students, typically second-year MBA students. It's an elective at both schools. I think there's still some fascination with the dark side of business. I do point out to my students that almost no matter what they do, whether it's in finance or directly in business or even in the nonprofit arena, fraud will probably touch their professional life at some point. And how to identify it and warn or insulate the effects of it is probably an increasingly important skill. That's number one. Number two, for those of my students that are more financially oriented, I make the strong point that the fraud cycle follows the business and financial cycle, but with a lag. So when you get these really, really long expansions and then also bull markets, people's sense of disbelief begins to erode. That's a point of maximum peril for investors and a maximum opportunity for fraudsters. So, that's why we saw the wave of fraud after the dot-com era, and probably right now as well. I've called this the golden age of fraud. But students are generally correctly taught to emulate success via the case method and instruction. But it's also important to alert them to signals, as I say, to the dark side of the business world, because it is there, it's significant, and it has a disproportionate impact through externalities and other mechanisms.
So come back to the Fed for a minute, only in the sense that Fed policy has clearly elongated cycles. So is it in these types of environments when liquidity is so flush and liquidity is presumably flowing to companies that don't merit it, is it more difficult in this environment to uncover fraud at companies?
Well, I mean, you can point it out, and on an isolated basis, like the Valiants and Wirecards of the world, it still can unwind. But when you have ample liquidity, and we have a macro model that we use as one of our 5 systematic models that I teach about the concept of fraud, and the macro model by Kindleberger and Minsky really has as one of its tenets credit creation and easy money. Uh-huh. That's a very fertile area for fraud to grow in, and so obviously we have that now. You have the idea of central bank puts throughout the markets, whether it's equities or others, that again enable people to think, well, generally, even if someone's not telling me the truth, I'll be okay. And so we're in that part of the phase of the cycle that people just are believing pretty much anything that people tell them because it's worked.
Well, and we also had the Fed step in and backstop the corporate bond market. When you were just 26 years old, you started off analyzing the junk bonds at Drexel Burnham. And now that market is in excess of $3 trillion if you add up high yield bonds and leveraged loans. Does any of this make sense in terms of the magnitude that we're seeing?
Well, only to the extent it's probably controlled by one person today, like it was back then. Back then it was Mike Milken. Today it's Jay Powell.
Wow, that's a powerful statement.
But I mean, I just think that look, as you point out, I mean, the Fed has expanded its mandate, and you know better than almost anyone. We now have 3 legs, the stool, right? It's inflation, it's employment, and it's asset prices. And now that we've added asset prices implicitly to the mix, you really have a witch's brew, because investors are now clearly counting on it. And I should go back to the .com era, which this era resembles the most to me. Mm-hmm. Obviously, every cycle is different, but the muscle memory of .com era is still pretty strong with me. And we forget that there was a Fed concept of a Fed put. The whole idea of the Fed put was evident back then and really kicked in when the Fed aggressively reversed its course and began easing after LTCM in October of '98. Yep. And that about face really kicked things off for the rest of '98, all of '99, and the first quarter of 2000. Where basically people said, look, anytime the markets are going to go down, and they went down about 20% in September, October of '98, the Fed has our back. And I go back to not the pandemic, but I go back to the fourth quarter of 2018. As the Fed was slowly tightening, the markets finally, had a puke moment. We're down 20% in the fourth quarter, and the Fed blinked, and they aggressively reversed course. This is a year before the pandemic. And so I think that since that moment, since that Christmas of 18, investors have really been emboldened by the fact that the central banks won't let them lose money.
So I'm curious, because what set that process off, or at least the very culmination of that process, was when the debt of General Electric was downgraded on Halloween in 2018, and then 14 days later, junk bond issuance froze solid, and the phenomena was the credit market bleeding into the stock market. And I'm curious, and I truly don't even begin to have an answer to this. How is it feasible or possible or not to try and benefit from overvalued corporate bonds?
Yeah, I mean, corporate. We've been short over our career. All kinds of corporate debt down through the years. And what's interesting is that it has often an asymmetric risk reward, because if you're shorting credit that's about to be impaired near par, you kind of know, other than the coupon, what your price risk is. You're not going to really go above par at maturity. So that's interesting. The problem, of course, is liquidity and borrow. You're often much more subject to agency risk when you're shorting corporate debt, because there are fewer holders than a widely held equity. And so, bonds can be called back. It gets a lot trickier. And that's one of the reasons why the CDS market grew so rapidly, among other reasons, 10, 20 years ago. But now the Fed is clearly buying, corporate debt. And that's obviously made that game, a lot more difficult as well.
Well, so let's get into a little bit of the history of your shorting. And my question is, what is the favorite short of yours in your history that no one asks you about?
That's a great question. We were very proud of our work that we did in the junk bond area to kind of complete the theme on Drexel back in the mid 80s. And what made Drexel so interesting to me was not only the companies that Milken was financing, but the fact that he was engaged in this amazing regulatory arbitrage that nobody figured out. And if you went back and looked, a lot of the corporate raiders that Milken financed had regulated financial subsidiaries in their complex that they that took in deposits, whether it was an insurance company like First Executive, or a trust company, or Columbia Savings and Loan, Charlie Keating's Lincoln Savings and Loan.
Oh my gosh, yes.
American Continental. And the rules are you can't dividend money up from regulated financial subsidiaries without approval and without profitability. And so these entities had billions and billions of dollars of cash and securities that the raiders really couldn't get their hands on. But Milken figured out a way to be able to do that. And he had them each buy each other's parent company debt. And as long as he could kind of control that flow, company A with an S&L would buy company B parent's debt in the S&L. And then when it became time for company A parent to issue debt, company B's insurance subsidiary would buy company A's parent debt. And it was a way to basically upstream money out of regulated subs. It was genius. And nobody ever figured that out. And so it's also why the Drexel collapse had much more systemic impact than you would think, because the daisy chain had dominoes embedded in it. Once the dominoes started to fall, the capital got impaired at all these leveraged financial subsidiaries. So that was some work that I think that we did that was not only kind of profitable but important. And then again, everybody of course remembers Enron, but we probably made a lot more money in the 2000 to 2002 time period on things like Lucent and WorldCom and some of the big leveraged telecom plays. Some were fraud, some were not, but almost all of them collapsed because of the telecom bubble. And I'm it's important to note I'm saying telecom bubble, not internet bubble. And I think that area was important. And then the other thing that in our history that you might find interesting, that I don't think ever gets much attention, is the warning at the G7 meeting in April of 2007 that Paul Singer and I gave to the world's central bankers and treasury ministry and finance ministers. We were asked by Bob Steele to make a presentation at the Washington G7 finance ministers meeting because at the time the Germans were making lots of noises about hedge funds as locusts. And Paul and I gave separate but kind of interlinked presentations on the risks of structured finance and just how much structured finance and derivatives were at regulated banks and brokers in the G7. And, it was, everybody was in the room. I mean, Gordon Brown was in the room. Mario Draghi was in the room. The Fed was there. I mean, it was everybody. And I always laugh when people say, well, nobody, no one issued warnings or no one whatever. I was literally in the room issuing the warning with all these people in the spring of '07. Because if you remember, the ABX had already collapsed in the first quarter of '07. Mm-hmm. And we had gotten financial information on the banks and brokers at year-end '06 of their holdings of so-called level 1, level 2, and level 3 securities. And it became very clear that a number of systemically important institutions held massive amounts of level 2 and level 3 securities, many of them, of course, in the residential mortgage arena. And it didn't take a rocket scientist to just take a look at what the ABX had done and magnify that on the level 3 holdings for the big banks and brokers and realize that most of them were insolvent.
And boy, did we ever. I mean, I'll never forget having to Google Landesbank, because I had no idea what a German Landesbank was. All I know is that was one of the first bombs that went off.
3 months. Yeah, that was 3 months later, Danielle, followed by Northern Rock.
Mm-hmm. That's absolutely right. I mean, gosh, that takes me back. Let's talk about China a little bit. China has had a long-standing goal of westernizing their economy, making it less industrial, making it more domestic consumption focused. And it seems as if they might have pressed the button on the property market a little too hard, and now they find themselves buried in unimaginable amounts of debt. And your average Chinese household is spending double that of what your average U.S. household is spending on for housing. So they don't have as much money to consume the other things that the Chinese authorities want for them to consume. But my question is, how did something of this magnitude, which you identified, how has it been so prolonged? Why is it just now that we're seeing, starting obviously with Evergrande, but clearly they look like dominoes falling?
Yeah, well, we'll see. This is the fourth instance since we've been kind of warning about China at the end of '09. This is the fourth instance now where the party has tried to rein in specifically leverage and real estate development, and in each of the three previous times the government has blinked, and I'm guessing we're in the process of blinking again, because each and every time the economy, forgetting the country's stated numbers, the country's economy went into stall speed pretty quickly, and they panicked, and so it's just endemic to the model, and I've called it the treadmill to hell, because when you have investment at almost 50% of your GDP, which is unprecedented, year in and year out, the good news is, as I've joked, your annual GDP on January 1 of that year, because you literally can plan it. The problem, of course, is if you never write anything off, you're deceiving yourself, because you're simply putting up structures that are uneconomic or empty just so you can print a GDP number. And it means that you're never going to get consumption to grow up, because, as I remember from my macroeconomics class 50 years ago, is I equals S. So if you have an economic model based on I, you have to have the S, and so savings rates have to equal the massive amounts of concrete they're pouring everywhere, in China. So when we started looking at China, investment was 46% of GDP. I think last year it might have dipped down to 43 or 44, as I recall. But I mean, meaningfully, it hasn't changed in 12 years. Consumption was, I think, 33 or 34. Now it's 37. It's up a little bit. But make no mistake about it. The Chinese economic model is based on construction, and specifically construction of high rises, and mostly apartment buildings. And China builds 20 million flats a year, whether they need them or not. And residential real estate, we think, is about 20% of GDP, residential real estate construction. And I saw Ken Rogoff's numbers, that he's probably in the ballpark that all real estate activities are about 30%
wow.
of GDP, and these are just staggering. These dwarf Japan in '89. This dwarfs Spain and Ireland in '06. I mean, these are literally off the charts kind of numbers. And yeah, I mean, it's going to be one of the great questions of the next 10 years is how do they get themselves off this model?
Well, I mean, I obviously I think we're going to find out, and we know that their fourth quarter might see a 5% print allowed by authorities. So I feel like we've run full circle through the fastest economic cycle I've ever seen, because we're seeing so many late cycle indicators, and we're back to talking about China being at a 30-year low growth rate. So this is deja vu within 18 months. I've never seen cycle compression like I have, and it really doesn't feel like this flash recession that we had for 2 months here in the United States. It doesn't feel like it doesn't feel like there was a bear market there.
Well, there really wasn't. I mean, it was 3 weeks, 4 weeks, and there was price movement, but it was not prolonged, and it was a V-shaped, recovery in the markets. Again, thanks to perceptions of central bank liquidity and a pretty aggressive fiscal stimulus. But China's a different animal because they are operating under different drivers, and so it really is. I mean, they're now talking about gearing up infrastructure spending again to offset private, construction, and I'm just laughing to myself because, when I started looking at China as an example, the island of Hainan, which is sort of their tropical resort island in the South China Sea, had one international airport. Since then, it has designed and built the second international airport, and now it's talking about a third international airport, all in the last 10 years. And the first one was a necessity, the second one was a luxury, but the third one is probably folly. And yet all of them will contribute to GDP by just simply being built. So, yeah, this is an unprecedented experiment in macroeconomic policy, and I really don't think it gets even the attention, even with Evergrande, that it deserves, because running investment at half of your economy for decades is just like nothing we've ever seen.
Yeah, I'll never forget a statistic that I saw maybe 12 months ago or so, to your point, that there were 30 airports in China either being updated or under full-blown construction. And I'm saying to myself, who's going to fly into all these airports? And it's just...
Yeah, and even if they do, will they be economic? I mean, will they even earn their costs?
Right.
And that's the real problem. Same thing with high-speed rail. Everyone loves it, looks great, it's very modern, but there's no return on the investment and the debt against it. So that's why and it gets to another problem with China, and that is debt in the banking system. And China is still a bank-centric system. Is still growing at 2x GDP, and it's down from 3x GDP 10 years ago, but 2x GDP will still kill you. The assets in the banking system year over year recently have been growing, somewhere in the low teens, about 12%. And so that compounding, starts to get you, and also tells you that probably a lot of those loans that are being extended are simply Ponzi finance. Right? They're just loans extended to keep the old loans current.
Yes, I'll never forget hearing that China had up and created a municipal bond market simply because they needed a receptacle, a place to put more debt, a place to move the money around to. So, but I'm wondering if you have any views on the wealth destruction and Xi Jinping and his future, and whether or not he's going to survive what's happening right now. There are rumblings starting to come out of China that he's gone a little bit too far in trying to rein in some of the successes of individuals.
Yeah, I've heard those rumblings too, but I would short them because the one thing that we have seen with his rise in 2012 and 2013 is that he was a new type. He was basically, I should say, an old school kind of Chinese leader. The first speech he gave as party secretary was a speech to the party faithful, saying that Gorbachev should have struck down perestroika when he had the chance. The Soviets had erred. And the Chinese set up an institute for the study of the Soviet collapse after Xi Jinping got in office. So Xi Jinping was the only major world leader who attended Putin's winter games in Sochi. And he's really identified with authoritarianism and one-man rule far greater than his predecessors, going back to either Deng Xiaoping or Mao Zedong. And, we clearly got indications that he did not intend to relinquish power when the second of his terms is up next year. So I've heard lots of things, particularly from always the business community, that, Xi Jinping is going to be reined in. He has to deal with other factions. And I would completely discount those. I think Xi Jinping has done nothing but strengthen his hold on power. I think that he's clearly now decided on a different strategy regarding the embracing of capitalism. You've been warned. They are very clear. One thing the Chinese Communist Party does do is tell you what it's going to do. And they are telling you what they're going to do. They're going to increase taxes. They're going to restrict the power of celebrity CEOs. There's going to be less impact on less emphasis on the 1% and more on the 99%. And you ignore that at your own peril as a Western investor.
So speaking of power bases, let's shift gears and come back to the United States. My former employer right now, the Federal Reserve, there seems to be quite the power struggle going on. What are your views on it? Well, is there anything that can halt the momentum when you combine the three powers of passive investing with Fed liquidity, with shareholder buybacks? Is there anything that can derail this momentum that seems to have truly taken on a life of its own?
Well, I would argue that the last one is questionable, because although share buybacks have come back somewhat, they're pretty focused in on high-end companies. And what we are seeing that's a difference, and I've always joked, you have to remember that Wall Street has a printing press too. It just takes a little while to get it oiled up. And Wall Street really, since the beginning part of 2021, has been issuing all kinds of stuff, particularly in the equity markets, whether it was the SPAC boom of the first quarter or the IPO boom we're in now. I mean, we're going to break records for equity issuance this year. And coupled with insider selling, I think that in my world anyway, we're just seeing lots of supply right now. And then, of course, you have the advent of the retail investor, which I think is the other big story, and the advent of, just an embracing of speculation, whether it's in stocks or cryptocurrencies or whatever have you. And undoubtedly, that's something that's new in the past couple of years. So as the market has gone higher and higher and higher, we've gotten, quite frankly, more and more unsophisticated investors who are chasing things at kind of, almost unprecedented prices.
So it looks like the Fed's going to be forced to taper its purchases. It looks like we're not going to get appreciably the same size of fiscal support, and I'm talking about direct money, direct to individuals, stimulus checks, unemployment benefits, supplemental. Is it going to make a difference when the Fed starts to tamp on the brakes? And do they have to? Because the difference between now and the financial crisis is inflation.
Well, I mean, so let's talk about that a little bit. I mean, the goal of Fed policy has been to get inflation, and now that we ostensibly have it, they're telling you, well, don't worry because it's transitory, and so, all right, there's that little conundrum, and then of course there's the concept of investors who have basically applauded the central banks and have said, okay, well, that liquidity is there and is bolstering valuations and risk taking, will effortlessly, for the most part, tell you why that liquidity being taken away is not bearish, because it indicates a robust economy, or take your pick. So, of course, investors will always find the glass half full explanation on all this, and that's fine. But sometimes the logic escapes me in terms of when policy does change. Look, the question before, and you're a Fed watcher, I'm not. Is are they going down the road to making a policy error, right? Are they just staying too easy, too long, and where we're going to get for the first time what they really wanted, which is an inflationary cycle going? And I don't know. I mean, I just that's above my pay grade. But clearly, the amazing amounts of support via QE and ultra low rates, we're probably at a inflection point again.
Does it matter to the markets who is running the Fed? I mean, they're dropping like flies. Would a change in leadership be a market-moving event? And or if you had your choice outside of the usual suspects, who do you think the market would welcome to run the Federal Reserve? It's pretty apparent by looking at the betting that it's not necessarily one or the other who are in the main running.
Unless Paul Volcker were to show up again, or the ghost of Paul Volcker, I don't think the market really cares. I think the market correctly assumes they're all dovish.
Got it. Well,
and so that's what we had, from the late '60s to the late '70s, and everybody was afraid to really, put the inflationary structure back, genie back in the bottle, and until Volcker showed up, and so. I don't see anybody on the current list that strikes me as particularly hawkish. So I suspect the markets really think the same thing. They pretty much think it's going to be business as usual, no matter who gets in.
So how is it feasible? We've obviously seen an attack on short sellers between the chat rooms and the Reddits. But if you had to pick your poison, would you write a report and then cover shorts as the news came out, or would you write a report and follow it all the way down?
Well, first of all, we don't write reports, so we're not a so-called activist short selling shop. We run money. I post things from time to time on Twitter or whatever, but we don't publish research reports with the idea of widely disseminating our views. And that's just us. We've been in business for 36 years. And so I think that's number one. Number two, the whole attacking short sellers is a little, as I wrote at the time during the GameStop frenzy, it's a little perplexing, right? Short sellers were the ones run over here, and so short sellers have been the victims, not the evil geniuses that the retail crowd is making them out to be. If you look at GameStop or AMC or any of the sort of meme stocks, they're all still up a ton in 2021, and arguably trading way above their fundamental value. So, it's a little bit watching the retail crowd. I've dubbed them, the QAnon of Wall Street, because they just, everything is a conspiracy theory. Everything is dark pools, naked shorting. The regulators in bed with hedge funds. I mean, and it's just fanciful. And when you try to point this out to people, they'll just tell you you're part of the conspiracy and you're part of the whole thing too. And meanwhile, the conspiracy is a pretty weak conspiracy, given that we've all been, in these kinds of names that they're talking about, the bears have been run over. So again, this whole thing is just sort of paradoxical and makes no sense. But it really does tap into a nerve, I think, for a lot of particularly neophyte investors who don't understand the markets and how they work, to just say, well, it's them, and that's a long held psychological observation, where when you can't explain something, it's they that are the cause of you overpaying for your out of the money call options.
So, I saw a report a few days ago that the short interest in Tesla was down to 1.9%. And, that was incredible to me. I mean, every time you hear a statistic come out, and now it's $1 trillion market company, blah, blah, blah. How do you wrap your head around the Tesla phenomena?
Well, we have a put position. We have about a 1% put position in this name. So I get it. Look, every bull market has one or two stocks that people pin their hopes and dreams on, way beyond the actual reality of what's happening on the ground. And I went through this at AOL in the late 90s. We had a 10x move against us at AOL, because I was convinced AOL was an accounting fraud. And it turned out to be exactly that. Except Time Warner bought it merged with it for $100 billion first, and then found out the hard way. But even if you go back, for a real company like Cisco, which was sort of the hardware darling of the .com era, and people projected onto Cisco not only their existing growth rates and profitability, but the fact that Cisco would become ubiquitous in hardware and would be making not just routers, but all kinds of things in the hardware space that would be needed to build out the internet. And if you look at a stock price chart of Cisco, it also went parabolic in late 99, early 2000, way beyond its fundamental value, because it became a hopes and dreams stock. And of course, Cisco, by and large, delivered on expectations over the next 4 or 5 years, but the stock dropped 80 or 90%. And that's kind of what Tesla feels like at this point in the cycle. It's not worth $1 trillion. You can't get there, but it's become a hopes and dream stock that you can't disprove. It will be in space travel. It will be in energy, generation and storage. It will be in AI. It will be in autonomous driving, and it will do all these things. Meanwhile, if you look at Tesla, it's a car company. You spread it out against all of the OEMs, the auto OEMs, the numbers look exactly like the other auto OEMs. It's a car company.
Speaking of market darlings and uninformed investors, let's shift gears to cryptocurrency, because when I'm in the Uber or the Lyft and I'm headed to this airport or that, and anybody I ever ask, well, what do you do? I say, well, I'm in economics and finance. I get one of two questions. I get asked about Tesla or cryptocurrency, and my stock answer.
That's a coincidence. Someone showed me recently the correlation between the two is like 0.9.
Oh my gosh. Well, now that makes a lot of sense. But my stock answer is, until there's an international framework around cryptocurrency in general and a better understanding in the regulatory community, I don't know that I can answer the question as to what the future of cryptocurrency is. I look at it more as kind of a go-go momentum asset class.
Yeah, and I would agree. It's an asset. It's not a currency. It doesn't fit most of the criteria for the use as a currency. I get asked by my students all the time, and one of the things I urge them to do is to dig a little deeper on one of our favorite characters in my class, who was a guy by the name of John Law, who was the man behind the Mississippi scheme in Paris in 1716 to 1720. He bankrupted an already bankrupt country. But John Law was also one of the greatest economic thinkers of all time. He was one of the first guys, way ahead of others, to think about the concept of utility of money and fiat. And he actually put out a really groundbreaking pamphlet back in 1703 or 5 on Money and Trade Considered. And a lot of economists consider it, one of the great economic treatises of all time. And in it, he talked about his ideas about fiat currency and why the modern state should embrace fiat. And everybody knew the downsides of fiat back then. Kings and queens have been clipping the edges of coins for centuries. Nobody trusted paper money. But he made some interesting observations that I think have a lot of relevance for the crypto debate. Because crypto is really anti-fiat at the end of the day. At least that's what its supporters claim. And Law pointed out that fiat had some inherent advantages, particularly in times of stress and uncertainty. Not only could the state enforce fiat through the use of taxation, enforcement, and the military and the police and all the instruments of the modern state, but that in times of trouble, what we would call a bear market or fear, the state also could adjudicate fraud and clear transactions. And my way of reading that was to say the state could basically also offer you deposit insurance. And so all the things that people laugh about with fiat and why they're getting away from fiat money printing and all the rest of that stuff we know, paradoxically is actually, I think, making the speculative environment greater, which is leading to appreciation of cryptocurrencies, number one. And number two, completely goes out the window when people start losing money and then on top of it start getting defrauded and realize there's no recourse to anybody in the crypto land. And say what you want, but an awful lot of people who want to get out of the stock market, put their money in the bank after they've taken a licking, at least know their money is good in a bank. I'm not so sure it's going to be good in a lot of the crypto exchanges. And we've already seen that in the bull market, where we've seen instances of fraud and where coins are lost or stolen, and there's no recourse. And so there are basic inherent advantages, particularly in times of stress and fear and bear markets, to having a state currency and having a state central bank, that in bull markets, everybody says, who needs them? And so I just warned my students to go back and read John Law. It's an interesting paradox that one of the greatest early economic thinkers on monetary utilization and utility is also one of the greatest financial criminals of all time. But I think people have to sort of think about what it is they're buying, what crypto represents, and what it represents a contra bet against. And I think that forgetting the fact that the chart goes up and to the right, most thoughtful crypto bulls will give you a long thought piece on why fiat is doomed and why you have to have limitations and so on and so forth. And most of that flies right out of the window when people start losing money.
Yeah, indeed. I wasn't really planning on asking you this question, but what is your view on gold?
I don't have a view on gold.
Well, then I shouldn't have asked you the question.
No, it's just not in my world. I've bought an awful lot of it, not for monetary investment purposes down through the years, but that's more on the social side than the financial side. So we'll punt on this question.
I fully respect that, and I can tell you that there's been a lot of carbon in my life as well, but I'm not a carbon investor myself. So touche on that. So telecoms headed into 1998, long-term capital management bailout, Fed put, but telecoms was a sector that you had identified. Are there any, or is there one sector right now that you see that is ripe for a decline when eventually this market turns? Is there one sector that stands out to you that's not necessarily a usual suspect when it comes to saying these stocks are overvalued? Is there something more nuanced that we're not looking at? And I'm talking about an entire sector.
Right. Yeah. So I think that a couple of areas that I would sort of warn people. I'm scratching my head still at commercial real estate cap rates. Particularly offices. We can argue till the cows come home. Will work from home be permanent? What will office utilizations be? Will we need all the space? But right now, you have cap rates in the commercial real estate arena because of where interest rates are that are just at eye-poppingly low levels, meaning the multiples are at just staggeringly high levels.
Yep.
And so there's lots of asset classes that I think are a lot more turbocharged than investors think to interest rates, both positively and negatively. And I think commercial real estate is one of them, because with people paying 4% cap rates for urban office buildings, I'm just looking at them and going, that's before CapEx. That just is insane to me. If you use 50-year life, which is kind of typical for a building, you're paying 2% cap rates. When the 10 years at 1.6, and is a highly liquid, asset, and you got a building you can't move that can be taxed to kingdom come. So that's an area that we're concerned about. That I would worry about when a lot of people have assets. The other one that scares the hell out of me, and I allocate capital as well as invest it. I sit on some investment committees, and I've been kind of sounding the alarm forlornly now for a few years. I just think that the embracing of private equity, to the detriment of public equity or other alternatives, I think is going to, by almost definition, be disappointing. You have if we consider what the private equity business model is, it's buying assets, either taking them private or in the private market at multiples that are at all-time highs now, with interest rates at all-time lows, and exit possibilities at wide open. And I think almost all those things have to stay and remain exactly where they are today to continue to have, the hope for returns that private equity is promising. But here's the problem. And I've looked at this at some of the portfolios that I'm on the committees on. And that is, if you look at more recently, the returns of private equity, net of fees, they haven't equaled, or they've just equaled, public stock market indices. Mm-hmm. So you are getting basically the same thing as an index fund, but much more illiquid and much more levered. And I keep asking the question that if we're buying private equity because they're leveraging up to buy corporate assets, why aren't we earning 2x or 3x the S&P? Why are we content to earn 100 basis points above or 100 basis points below? And that's a head scratcher for me. And hedge funds have faced the same problem over the past 10 years. Hedge funds feasted post the dot-com era, but really have struggled to produce alpha as a group since then.
Yep.
And consequently have seen, relative basis that the AUM mean less to the detriment of venture capital and private equity. But private equity is a head scratcher for me. I'm puzzled by how easily it's embraced without people asking the right questions. If you own leveraged equity at a time in which interest rates have come down to almost zero, why haven't you beaten the stock market by not, as I said, 100, 200 basis points, but why haven't you beaten the stock market by 2x?
Right. No, I couldn't agree more. In fact, as you're sitting here describing this, public pensions, it seems like the more underfunded they are, the greater their exposure to private equity. And at the same time, I follow residential real estate very closely, but as a parallel to your office cap rate, private equity has been piling into multifamily high rises, and multifamily cap rates are even lower than that of office.
Yeah, it's kind of crazy, and again, everybody's operating very comfortably on the idea that interest rates will never go up. I mean, even if we just normalized interest rates to economic activity, forgetting inflation, we probably should be a lot higher than 1.6% on the 10-year. And a couple hundred basis points move on rates would just destroy real estate valuations, given where they are right now. And I just don't get it. And so that's one area. The private equity conundrum is certainly another that I think more people, big picture, should think through.
So my last question is you've been called the financial sheriff. If you were to give, if it's your final lecture of your fall or your spring semester, and your parting guidance to your students about forensic accounting and about sniffing out fraud, what would your final bit of wisdom be to those students and to anybody watching today in terms of the role that short selling should play?
Yeah, I mean, so exactly. I mean, I've long quipped that short sellers are financial detectives, and regulators are financial regulators are financial archaeologists. They'll tell you what happened, 10 years after you've lost all your money. And I think that we want to have a group in the free market that is incentivized to ferret out this stuff in real time. And I've told Congress that, and I've told anybody that if we're going to embrace a free market system, and we're going to try to allocate capital so that it doesn't end up in the hands of the fraudsters, you need a group of people that are incentivized to actually, go look for it, because the regulators won't get it in real time. They never have. And so you really do need journalists as well as short sellers and actors like that performing in the marketplace to root this stuff out. And I think that's a really important role and should not be forgotten.
Well, Jim, I can't agree anymore. I mean, you're effectively the whistleblowers for the stock market, and whistleblowers obviously have a place. You look back, and I want to take my hat off to myself. I didn't ask you about Enron, and I'm not going to. But
20th anniversary.
20th anniversary. Wow. So many of my friends who graduated in 1996 went off to Enron, and I kept saying to them, I still can't understand their business model, and nor could the people who were going to work for them explain it to me. So, anyways,
Yep.
Water under the bridge. Jim, I really appreciate you taking all this time today. I've learned so much, and I'd love to revisit in a year or so and look back on this unprecedented era in financial market history.
It was my pleasure, Danielle. Anytime.
Thanks. Take care.
Bye-bye, guys.
Well, I hope you found visiting with Jim Chanos as fascinating as I did. If you want to think of him as kind of on the opposite end of the spectrum of Warren Buffett, who buys a stock and holds it for its life, he is, as he described himself, he is a financial detective. And he rightly points out the critical role of short selling in the financial markets. And I hope you appreciate his views. I was particularly intrigued with his views on commercial real estate, private equity. If you're interested in some things that are also not on the market's radar screen, I recently interviewed Dennis McGill of Zelman Associates, and he brought up some interesting, intriguing findings on demographics that I think you'll find a great accompaniment to the visit that we've just had with Jim Chanos. So, and if you haven't subscribed, please do so. Watch that McGill interview, and until the next time, this is Danielle DiMartino Booth with Down the Middle. Thank you.